It's all about becoming a big fish in a small pond. And when you become a big fish, it's time to move into a bigger pond. The relevance of this phrase to the topic of today's discussion, strategies of market targeting, will be seen as we move ahead. Target marketing tailors a marketing mix for one or more segments identified by market segmentation. Two important factors to consider when selecting a target market are the attractiveness of the segment and the fit between the segment and the firm's objectives, resources, and capabilities. Well, now, to look at the attractiveness of a market segment, following are some aspects that should be considered when evaluating the attractiveness of a market segment. To begin with, size of the segment, growth rate of the segment, competition in the segment, brand loyalty of existing customers, attainable market share, required market share to break even, sales potential for the firm in the segment, expected profit margins in the segment. Market research and analysis is instrumental in obtaining this information. For example, buyer intentions, sales force estimates, test marketing, and statistical demand analysis are useful for determining sales potential. Now, suitability of the market segment is another area that needs to be focused on. It's necessary that market segments be evaluated according to how they fit the firm's objectives, resources, and capabilities. Some aspects of fit include whether the firm can offer superior value to the customers in the segment, access to distribution channels required to serve the segment, and the firm's resources versus capital investment required to serve the segment. The better the firm's fit to a market segment and the more attractive the market segment, the greater the profit potential to the firm. So how is market targeting actually brought in practice? Well, there are several different target market strategies that may be followed. They usually can be categorized as one of the following: single segment concentration, selective specialization, product specialization, market specialization, and full market coverage. Now let's see how each of these strategies work. To begin with, single segment concentration. In this strategy, the company selects a single segment, that is, a single product category, to a single market group. Through focus or concentration marketing, company gets strong knowledge of segment's needs. Hence, the company can achieve strong market position in that segment. It may have operating scales economies through specializing in its production or distribution or promotion. However, if it becomes market leader, company may earn more returns on investment. Yet, there are a few risks involved, and these risks are higher than normal. The increased risk is due to competitor invading segment, and market may collapse or become unprofitable to service. The video you just saw is a perfect example of single segment concentration. It's a children's hospital. The next strategy to talk about is selective specialization. In this strategy, the company selects a certain number of segments, each of which are attractive and in line with the company's objectives or resources. There may or may not be synergy among segments, but each segment has profit potential. Multi-segment coverage helps to spread risk. Even if one segment becomes unattractive, company can continue to earn in other segments. What best can explain selective specialization apart from Colgate, which has got variety of products for different groups of the market. The third strategy to talk about is product specialization. In this strategy, the firm specializes in a particular product and tailors it to different market segments. The downside risk is that the product may be supplanted by an entirely new technology. A laptop making company can be the best example to explain product specialization. Next, we move on to market specialization. In this strategy, the firm concentrates on serving many needs of a particular customer group. The firm gains a strong reputation in serving this customer group and becomes a channel for additional products the customer group can use. The risk involved is that the customer group may cut its budget due to various resources, like recession in its own business. The best company to explain market specialization strategy is Johnson & Johnson. The variety of products that they offer, for example, soap, oil, cream, body wash, lotion, and wipes, cater to all the needs of this segment. And last but definitely not the least, full market coverage. In this strategy, the company tries to serve all customer groups with all the products that they need. This strategy is normally undertaken by large firms. The whole market can be covered to differentiated marketing and undifferentiated marketing. Now, what's the difference between these both? Let's talk about undifferentiated marketing first. In this, the firm ignores market segment differences and goes after the whole market with one product offer. It focuses on core buyer need rather than differences among buyers. It relies on mass distribution and advertising. The company tries to endow product with superior image in people's mind. As a result of scale economies, prices may be low. This helps to win price-sensitive customers. Not easy a strategy to sustain as the competition increases. And if competition increases, there is increased intensity in larger segment and neglect of small segment. And differentiated marketing. In this, the firm operates in different segments and designs different products for each segment. More commonly, it is followed in the competitive markets. It creates higher sales than the undifferentiated strategy. However, costs also could go up due to increase in product modification cost, manufacturing cost, administration cost, inventory cost, promotion cost. Hence, probability needs to be monitored carefully. Companies should be cautious before over-segmenting market. At times, segments may need to be merged to broaden customer base. This is called counter-segmentation.